everyone. Welcome again. So my name is Hui Shi and I'm from the research team at iFAST. So you just heard from my colleague Dejin about how we are starting to see attractive value emerging within the fixed income asset class. For many decades, the world had enjoyed low inflation and an accommodative monetary policy. This also meant that interest rates were extremely low and bond yields offered little returns. As a result, many investors saw stocks as the only viable option to generate reasonable returns for their portfolios. Back then, we were in an investment landscape that was also called the TINA market. Now, TINA, it is an acronym. It stands for There is No Alternative. And this is made in reference to investors seeing no viable alternative other than stocks to put their money in because interest rates were just so low. But today, that is actually no longer the case. We have entered into a different investment landscape, one that is categorized by a structurally high inflation as well as higher for longer interest rates. And with this, the bond market is becoming a more interesting place for investment. We no longer have to rely only on stocks to generate nice returns for our portfolios. And I think it's time for us to say goodbye to TINA. And in fact, new acronyms are beginning to take its place. For example, there is an acronym called BORROW, which stands for Bond Earning Real Yields, lovely. And we also have TERA, which is an acronym for There Are Reasonable Alternatives. And we have BUB, Bonds Are Back. I think there's a presentation by a fund house later on with a similar title. There are even more examples, but I won't go through them one by one. I think you can pretty much call it what you want. Just get this important point which I'm trying to put out here, which is that fixed income is now providing higher yields, and this is providing investors with the potential to receive better or lovelier returns. And I think that is underpinning the growing attractiveness of fixed income as an asset class today. So if you take a look at the global bond yields now, they have climbed to nearly about 4%, similar to what was seen during the global financial crisis back in 2009. And today's higher bond yields, they can be mainly attributed to monetary tightening, as well as widening credit spreads as markets price in an economic slowdown. And in the past, there were plenty of negative yielding debt, meaning that investors who bought into this kind of bonds, they actually lose money. But today, thankfully, this is changing because the world's pool of negative yielding debt has shrunk to a 7-year low due to higher interest rates. And meanwhile, credit fundamentals across the global credit universe remain in good shape. Debt metrics have experienced a meaningful fall from their peaks during the COVID-19 pandemic. Corporates hold ample liquidity with strong interest coverage ratios after taking advantage of the low interest rate environment over the past few years to refinance their debt at lower rates. So such healthy credit fundamentals combined with today's higher bond yields is providing investors with a fairly attractive entry point. And this should also enable fixed income as an asset class to play a more relevant role in enhancing the risk-reward ratios of our portfolios. And on a relative basis, fixed income has also become more attractive. So simply compare the yield of global bonds against the earnings yield, which is equals to the inverse of the PE ratio of global stocks. And you will find that the surge in bond yields has far outpaced the increase in earnings yield, causing the yield spread between equities and bonds to narrow further over the last few quarters, reaching around 3.1%. And this 3.1% is actually its lowest point on record since 2009, and is actually now over 2 standard deviations below the 10-year average. Now, what this suggests is that equities have become relatively more expensive as compared to bonds, and that investors are now actually poorly compensated for taking on equity risks. And therefore, we believe that there's no clear need for investors to rush into risk assets, such as equities, to chase yields or returns any longer. With the days of TINA clearly over, we think that now is the time for investors like yourselves to start going back into fixed income. Furthermore, we expect the global economy to sail towards a recession in 2023. And the implication of this is that risk assets like equities will face headwinds as companies will experience slower earnings growth. And we also believe that inflation is in a structural shift, categorized by shortages in commodity and labor markets, as well as deglobalization. So companies are likely to see their margins increasingly under pressure. And if you put this together with a slowdown in earnings growth, we think that equity returns are likely to moderate moving forward. Now, with the return of relative attractiveness for fixed income compared to equities, as well as taking into account the headwinds to risk assets against an uncertain macro backdrop, we urge investors to take on a more defensive positioning by overweighting fixed income relative to equities in your portfolios. And within fixed income, we prefer to move higher up in quality, which also means that we're actually currently not too keen on high-yield bonds. While high-yield bonds, they do offer attractive income, we think that a defensive positioning may be more important in a recessionary or even a stagflationary environment. For riskier credits like high-yield bonds, slowing earnings growth as well as dampened margins are likely to significantly raise credit as well as default risk, paving a way for a further widening of credit spreads. So if you look at the credit spreads of global high-yield bonds right now, as shown on the screen, they remain quite narrow at about 550 basis points. So this is below its historical average, and also it's quite a stretch away from past recessionary levels. Overall, the greater sensitivity of high-yield bonds to the economic outlook suggests greater room for spread widening and hence a relative underperformance as compared to investment-grade bonds. So this is also why we prefer investment-grade bonds over high-yield bonds, because an allocation to safer segments within fixed income would allow investors to capture the higher yields from the asset class without having to take on too much credit risk. Now, in terms of duration exposure, we actually prefer short duration bonds. So, the yield shape of the US yield curve actually right now is quite flat, with the inversion seen between the 2-10 spread and also the 3-month as well as the 10-year spread. So clearly, yields on the shorter end have moved up a lot higher as compared to yields on the longer end. And as a result, short-term bond yields, they are more competitive. So if you take a look at this chart shown on the screen here, a year ago, investors can get a decent return of up to 0.9% by moving away from the 1 to 3 year maturity bucket. But today, if you move along the yield curve, you can hardly get any yield pickup. So in other words, going short duration means that investors can receive attractive yields without having to take on greater duration risk. And besides that, there are also other important reasons why we prefer short duration. While long duration bonds, they do historically outperform during a recession, we believe that this time will be different, because we see the potential for long-term yields to move up even higher as we think that markets are underestimating the persistence of inflation. So right now, markets think that the Fed will cut rates significantly as soon as 2023 in order to combat a recession. But this is where we differ. Even if a recession comes, we don't think that a Fed will cut rates this year. And the Fed officials have also expressed their intentions of keeping rates higher for longer in order to fight inflation. And we think that markets have not woken up to this reality yet. And without a rate cut, the slope of the yield curve is not expected to steepen meaningfully. And that also suggests that now is not yet the time for investors to shift towards longer dated bonds. And moreover, short duration bonds, they can benefit from the pull to par effect, meaning that even as short duration bonds experience mark-to-market losses because of market volatility, they should still produce some upside for investors along the way as their prices approach par value upon maturity. And meanwhile, longer dated bonds, they typically do not benefit from this kind of pull effect because the maturity date is too far away to provide investors with a reasonable amount of certainty regarding principal repayment as well as the market yields. Now, considering all of the different points that I've just mentioned, we think that the best place for investors to be right now is in fact in the short-dated investment-grade bonds. In summary, higher interest rates have enabled bonds to present attractive yields which are not seen in more than a decade. investors can no longer complain about bond yields being ridiculously low. And with the higher yields today, we think that bonds are now able to serve as a viable alternative to stocks. And from a portfolio perspective, we actually prefer fixed income over equities. And this defensive positioning comes as fixed income has finally regained its relative attractiveness compared to equities, as well as the expectations of the global economy sailing towards a recession that will slow earnings growth, as well as a structurally high inflation that will dampen companies' margins. Now, within fixed income, we believe investors should stay up in quality by opting for investment-grade bonds, allowing investors to get higher yields from the fixed income without having to take on too much credit risk. And in terms of duration, we believe that it should be kept short. Value is to be found in short duration bonds, as investors can receive attractive yields without having to increase their duration risk. And furthermore, we hold the view that a Fed rate cut in 2023 seems highly unlikely even if a recession comes. So this also means that now is not yet the time to shift towards longer dated bonds. So at this point in time, I hope that you will start to pay more attention to fixed income if you haven't already. And to help you get started with investing within this asset class, in the next couple of slides, I will also share with you some of our recommended bond funds. Now, the first fund that I've highlighted here is called the United SGD Fund. This fund aims to achieve a yield enhancement over SGD deposits with a long-term view to preserve capital by mainly buying into investment-grade bonds. The fund uses a 3-year bond ladder approach, meaning that it staggers its bond investments with different maturity dates across a 3-year time frame. So this ensures a steady stream of cash flows while enabling the fund to take advantage of higher interest rates in the rising rate environment. And looking into the fund's composition, we observe that it is diversified across different Asian markets. But any foreign currency exposure is actually hedged back to the Sing dollar in order to mitigate the risk of currency fluctuations. Now, considering China's sizable role within the Asian fixed income universe, the bond's largest market allocation is actually to China, but only at about 24 or 25% of the portfolio. Within China, the fund has a preference for bonds which are issued by state-owned entities, also known as SOEs, whose economic values are driven by state policies as well as they are of great importance to the Chinese government. And now overall, the fund has an average credit quality of BB+, which is investment grade. Its duration is short, and in the current environment of rising interest rates, the fund has reinvested into higher yielding bonds, allowing its portfolio yield to climb to over 5%. And the next fund that I've highlighted here is called the Lion Global Short Duration Bond Fund. Now, this fund invests mainly in SGD-denominated bonds of investment-grade quality to lower overall default risk. So in other words, this fund targets investors who wish to earn a higher yield compared to fixed deposits or money market funds by taking on slightly higher credit risk. In line with its investment objective, its largest market allocation is to Singapore at close to around half of the portfolio. And again, all of the non-SGD positions are actually hedged back to the Sing dollar to mitigate currency risk for local investors. And the fund has an average credit rating of BBB, and its portfolio also produces a yield of around 5%. The duration exposure is short and is targeted to be kept below 4 years. And third, the next fund that you should really check out is the Nikko AM Shenton Short-Term Bond Fund. Now, this fund seeks preservation of capital and liquidity, so it invests in a diversified portfolio of good quality short-term bonds as well as money market instruments. And with such high-quality investments, the fund has an average credit quality of A-. It's also diversified. China makes up the highest allocation, but only at about 20% to 23% of the portfolio. This is followed by Singapore and Hong Kong, which are the second and third largest markets respectively. And similar to other funds that I mentioned, non-SGD positions are hedged back to the SGD. The fund's duration is very short at only about 1 year and is expected to be kept short due to the deployment of additional cash towards bonds of around 1 to 2 years maturity. And with this current positioning, the fund has achieved an attractive portfolio yield of 5%. Overall, I believe that such funds will appeal to conservative investors who are looking for a yield pickup over money market instruments. The fund's allocation to high-quality, short-duration credits not only limits downside risk during market volatility, but also is able to generate a steady stream of cash flows. And out of the 3 different funds that I've just mentioned, I believe that this particular Nikko AM Shenton Short-Term Bond Fund will probably stand out to you, as it is the safest option as measured by its average credit quality. So what I've shared so far, their funds focus on SGD denominated bonds as well as the Asian fixed income market. Now moving on to global bonds, which is another segment that we quite like. A recommended bond fund for the global bond market is the Allianz Global Opportunistic Bond Fund. What is unique about this fund is that it uses an unconstrained bond strategy, meaning that it is different from traditional bond funds in a way that it is not managed against a fixed income benchmark, but rather a cash-based index. And therefore, the fund has higher flexibility when it comes to its choice of fixed income assets. It seeks to exploit the best opportunities from global fixed income markets across the cycle and provide investors with decent returns regardless of the interest rate environment. Now, in view of the weak economic growth, inversion of the yield curve, as well as high inflation, markets have become risk-averse. And in line with this, the fund's credit asset allocation has actually gravitated towards developed market government bonds, the majority of which are US Treasuries. And as a result, the fund has a very high average credit quality of AA. Its portfolio produces a yield of over 4%. Duration exposure is currently at about 3 years, though due to its unconstrained nature, its duration exposure at any point in time can actually range from as short as near 0 years to as long as 9 years. We believe that investors should look beyond traditional bond strategies which lack the ability to adapt to the ever-changing market environment. Unconstrained bond funds, such as this fund shown on the screen, is able to react quickly to changes in market circumstances while striving to seek out the best opportunities from global fixed income markets. Now, putting everything together, fixed income is becoming more attractive, and we hold a favorable view on high quality as well as short duration bonds. Now, in the short duration bond space, our recommended funds, the Nikko AM Shenton Short-Term Bond Fund, United SGD Fund, and the Lion Global Short Duration Bond Fund, currently hold portfolios that yield around 5%. And over in the global bond space, we prefer an unconstrained bond strategy, such as the Allianz Global Opportunistic Bond Fund. And this is because unconstrained bond funds can react quickly to changes in market circumstances, such as adjusting their duration exposure along the interest rate cycle. And also, moving into 2023, we expect the US dollar to peak, and therefore we advise investors to hedge their USD exposure where possible. And that is also the reason why we have opted for the SGD hedge share class for the Allianz GOB fund. And with that, I've come to the end of my sharing for today. Thank you so much for your kind attention.